Hello everyone, let's continue our class. Before we go through more materials, let me ask you several trivial questions. The first one is, how do we calculate expected return for a stock? Remember that past return doesn't equal to future return. In order to get a better estimation of future return, we need to consider multiple scenarios. Bad versus good. And expect return for individual asset equal to weighted average returns under several different scenarios. And to calculate expect return for a portfolio, we use a weighted average. That is a weighted average expect return of individual assets. And the weight here is the weight of investment in your portfolio. Now, let me ask you a second question. How can investors deal with risk in their stock portfolio? Well, we developed several measures to measure risk. But in order to reduce risk, to handle risk, people need to do more. And the key here is diversification. Diversification can reduce risk effectively in your stock portfolio. To do diversification, investors need to add more stocks in their portfolio. By combining several financial assets in their portfolio, investors can reduce or even eliminate so-called unsystematic risk. So what's left in their portfolio is so-called systematic risk. And the systematic risk cannot be further reduced because systematic risk is market risk, and those risks are not due to individual companies' characteristics, but due to macroeconomic impacts such as GDP growth changes, the changes in interest rates, inflation, so on and so forth. And those macroeconomic events will affect all stocks. So no matter how hard you try adding securities in your portfolio, there's no way that you can eliminate or reduce market risk or systematic risk. So what really matters for investors from now on, if they choose to diversify their portfolio, is market risk. And in order to measure market risk, we needed to develop new measures. Previously, we used variance and standard deviation, but both can only measure total risk in your investments, which incorporates both systematic risk and unsystematic risk. Since unsystematic risk can be diversified away when investors build a portfolio, what really matters for investors here right now is systematic risk. And the new measure for systematic risk or market risk is called beta. And this beta measures the relative stock volatility to the market average. I mean, for both standard deviation variance, you see absolute measurement in terms of percentages or numbers. But beta here is slightly different. Beta only measures the relative level of risk of individual stocks to the market average. If beta equals 1, that means the stock has the same risk as the market average. If beta is greater than 1, that means stock is riskier than average. If beta is less than 1, the stock is less risky than average. And on the financial markets, you will see that most stocks have beta in the range of 0.5 to 1.5. And by definition, the beta of the market is equal to 1. And since T-bill has no market risk, therefore the beta for T-bill is 0. Let's take a look at an example for beta coefficient for many different companies in this table. As you see, different companies have different betas, and those betas measures of systematic risk or market risk for individual stocks. Some beta have less than market average systematic risk. Others may have higher than market average systematic risk. And in this table, you see there are four stocks. That have less than, that are less risky than market average. They are Costco, Amazon.com, Yum Brands, and the Home Depot, because the betas here are less than 1. And also we found that there are 5 stocks here are riskier than market average. They are Apple, Google, Starbucks, eBay, and Citigroup. And among all 9 stocks, Citigroup is the most risky one because the beta is the highest one. So higher beta means higher systematic risk, and the lower beta means lower systematic risk. Now, let's do a practice to see how we can find a beta in Yahoo Finance. Now, let me open the page for Yahoo Finance. Finance.yahoo.com. Let's say we need to look at the beta of a specific stock. For example, Google, G-O-O-G. That is the ticker for that stock. Right. Then we click on Go. Okay. Now here you see many information associated with this stock, and Google has a new name of Alpha Beta Inc. And right now the price is $19.84. It's been up slightly today. And here you see many numbers. For example, open price, bid ask, 1 year target. And here you see beta. Beta equal to 1.032. So if you visit any major website and look at its finance pages, and when you type in the ticker of individual companies, you will find its beta. And the beta 1.03 here means that Google has similar systematic risk as the market, right? Although it's slightly higher, 3% higher, right? So be precise. From this information, you would say that Google is 3% more risky than the market average. Right? Now let's take a look at another stock. Let's say Facebook, FB. That is the ticker of Facebook. And let's look at that company. And this company has beta of 0.84. And that number means Facebook is less risky than the market average. Right? So beta is a great measure for unsystematic risk or market risk. It can easily be found on any finance web pages. Now let's go back to our lectures. Now let's say you have a portfolio. You don't just invest in one company, right? You know that is risky, and you want to apply the principle of diversification. And instead of having just a Facebook, you add, let's say, Apple, Microsoft, Coca-Cola, Walmart, so on and so forth into your portfolio. When you hold a portfolio, you want to focus on portfolio's return and risk. And when we say risk here, it's no longer total risk, because we know if we have a well-diversified portfolio, unsystematic risk can be diversified away. And the only thing that we need to worry about is market risk, which can be measured by beta. And the portfolio beta here equals weighted average betas for individual assets in your portfolio. And here's an example. Here is example for you to distinguish the difference between total risk and market risk. Let's say we have 2 stocks, security C and a security K. And those 2 stocks have 2 have different standard deviation and a beta. Security C has standard deviation 20% and 30% for security K. And from here, you would say security K is riskier than security C in terms of standard deviation. That means in terms of total risk, K is higher than C because standard deviation is 10% higher. But when you look at the beta, you see beta of security C is 1.25 and the security K has a beta of 0.95. So essentially speaking, you would say, hey, higher beta means higher risk, and C has higher beta, that means C is more risky than K, but based on standard deviation is the opposite. So what's the problem here? The problem here is we needed to distinguish systematic risk and unsystematic risk. Standard deviation measures total risk, which incorporates both systematic risk and unsystematic risk. And only beta measures systematic risk. So in this case, in terms of total risk, security K is riskier. But in terms of systematic risk, you would say C is riskier than K in terms of market risk or systematic risk. If you invest in either security C or security K, which one would you expect to have higher return? That is that is pretty tricky question, right? And some people say, hey, higher risk means higher return, but here you need to distinguish systematic risk and unsystematic risk. And in terms of standard deviation, you would say, hey, I expect to earn higher return if I invest in K instead of C, right? But look, if investors have diversified portfolio, only market risk matters, right? And only market risk can be rewarded for its future return. So here, investors should expect to receive higher return in C than K because C has higher beta. And here we know beta measures market risk. If investor bears more risk, then the market will reward investor with higher return. And that excess return is due to risk bearing. And risk premium here should equal to expect return minus risk-free rate. And RF here means risk-free rate. If investors invest in diversified portfolio, what's really matter here is systematic risk, right? And since beta measures systematic risk, therefore higher the beta, the higher the risk premium it should be. Right? So the true relationship between risk return should be the relationship between expected return and the market risk or systematic risk that can be measured by beta. And essentially speaking, higher beta means higher risk premium and higher expected return. Now you see the full picture of risk-return trade-off in this SML or security market line. And here you see two-dimensional picture. On the x-axis, that is asset beta. And asset beta measures market risk. And on the y-axis, you see expected return for individual security, or ERI. I means individual security. And the true relationship can be expressed in this SML or security market line, which is a dark green line that you see on this picture. And if investor doesn't want to bear any market risk, then the return is not a zero. The return is risk-free rate. If investor wanted to improve its return, then they have to bear more market risk. When beta is increasing along the x-axis, you will see that expected return can be improved on the y-axis. And if we express this security market line in mathematical formula, then you will see ERI, which is expected return for individual security, equals, first item here, risk-free rate plus beta of that individual stock times the difference between expected market return and the risk-free rate. And we call this as market premium. Market premium. When investing in stock market, it's more risky than investing in risk-free asset. Therefore, investors should expect higher return to compensate for equity market risk. And this is called market risk premium, which is the difference between expected market return, or ERM, that is expected market return, and the risk-free rate. Then you time that item with individual companies' beta. And this equation and as well as this graph show to you a very, very important thing in finance. That is capital asset pricing model, or so-called CAPM. And a CAPM build a foundation for finance. And any finance principles, any finance mechanisms, more or less has something to do with this capital asset pricing model. And this model seems sophisticated thing for you to comprehend, but essentially it only deals with two essential elements in investment. One is return, the other one is risk. It's just that the return here should be expect return or future return, and the risk here should be market risk that can be measured by beta. So this security market line and a capital asset pricing model that can be expressed in this formula essentially show you a function between expected return and the beta. Now let me introduce another important concept within the framework of capital asset pricing model, that is reward to risk ratio, which equals to market the excess return, which is difference between expected return for individual asset and risk-free rate divided by beta of that individual company. So it is a ratio of excess return and market risk, and that will give you so-called a reward to risk ratio. It measures the actual return that an investor can earn by bearing each unit of beta. And on this line, on the security market line, you will see that the reward to risk ratio is essentially the slope of this upsloping line called security market line. In equilibrium, this reward to risk ratio should be the same for all assets, right? It's for all assets, because if you want to earn higher return, then you have to bear more market risk, which can be measured by beta. Right? And by saying equilibrium, we believe that asset price are fairly priced. All securities are fairly priced, and the risk return trade-off should all stay on this security market line. Right? So if risk and return profile for a security is exactly on this dark green line, we say that okay, this security is fairly priced. But sometimes security market may misprice some securities, and some security may have risk and return trade-off above this line or below this line. In both cases, we can say that okay, those securities are mispriced. If it's above this line, the security price is undervalued. If it's below this line, we say that this security is overvalued. Right? So once again, if it's above this line, it's undervalued, which means stock price may increase in the future. If it's under this line, it's overvalued, indicating that the stock price is not a good deal for investors. And any security that is on this line is fairly priced. So in market equilibrium, let's assume that all securities are fairly priced, then the reward to risk ratio should be the same for all securities and for the market. Here's more information about security market line and the slope of the security market line, which is called the reward to risk ratio, which is the slope of that security market line. And the security, if we express this security market line mathematically, you will get this equation. And this equation, along with this security market line, is essential part of capital asset pricing model. Once again, expect return for any individual assets equals risk-free rate plus risk premium of the stock market times its beta. And risk premium, RPM, here equals expected market return minus risk-free rate. Right? So let's spend a little bit of time. Make sure that you are comfortable with this equation, because you're gonna use this equation in multiple occasions when you practice homework questions and taking exams. RF is risk-free rate, and typically we can find proxy for risk-free rate by using T-bill or T-bond rates. And RN is market return. And practically we use S&P 500 stock market index as a proxy for market return. And RM is market risk premium, which is equal to expected market return minus risk-free rate. And then ERI, once again, is a required rate of return for individual asset or expected return for individual asset. Right. So here let's look at this capital asset pricing model in terms of its formula. ERA equals RF plus the difference between expected market return and the risk-free rate times the risk beta of stock A. And capital asset pricing model is very useful for any investors and finance people in your corporation. And essentially, it shows the relationship between beta and expected return. And the beta is the measure of market risk. So this capital asset pricing model shows the relationship between market risk and expected return for a security. If we know beta in this equation, then we can estimate expected return for any individual securities. Now let's do a little practice to see how we can calculate expected return based on beta of individual stock. And in this table we have two stocks, stock A and B, and stock A has beta 1.3 and the stock B has beta of 0.8. Right? And here you need additional information, which is associated with the market return and the risk-free rate. So market return here is 12% and risk-free rate is 7.5%. So let's apply this equation to see what is required rate of return or expected return for both stocks. For stock A, expected return equals risk-free rate 7.5% plus risk premium. The difference between expected return for market, which is 12%, and the risk-free rate. That will give you 4.5% market risk premium. Then you times that number with beta 1.3. You times that number with 1.3 to get expected return. Right? So expect return for stock A equals 7.5% plus 1.3 times 4.5%. You may ask where does that 4.5% come from? Well, 4.5% equals market returns 12% minus risk-free rate of 7.5%. And the calculation will show you that required rate of return is 13.4%. Right? and we follow the same calculation for stock B, and you will find that expected return or required rate of return for stock B equals 11.1%. And here I want you to do calculation by yourself for at least 3 times by using different stocks. Make sure you get exact number that you see here. Right? And in this capital asset pricing model, we found that three return drivers for stock. The first one is RF, because this expected return of individual stock is a function of not only beta but also risk-free rate and the market premium. And the risk-free rate here measure the pure time value of money. If time value of money is increasing, then expected return should be higher. And the second one is market risk premium, RPM, which is the difference between market return and risk-free rate. And this measures reward for bearing systematic risk. And this term depends on investors' risk preference. If investors on average are more aggressive in taking risk, then you will see lower market risk premium. If investor on average is less aggressive in taking market risk or more conservative, then this RP would be a higher number. So when investors on average is more conservative, you would expect higher risk premium, therefore higher expect return for the stock. And of course, this beta measures systematic risk of individual company. And here's more quiz questions that you can ask yourself. How do you compute expected return standard deviation? Second, what's the difference between systematic risk and unsystematic risk? And third one, what type of risk is relevant for determining the expected return? Right? So from this lecture, you know, for the third question, only the systematic risk is relevant in estimating expected return for a single stock based on CAPM model or security market line, or the true relationship between risk and return. Remember, when portfolios are well diversified, only risk that worries investors is systematic risk or beta. And here's a more practice by using CAPM model. All right, I think we complete this chapter, and it's my pleasure to announce that all chapters are covered for the entire course, and it's time for you to review the lecture, practice homework questions, and I expect you to complete those homeworks before you take the third exam. The third exam covers chapter 8, chapter 10, and chapter 11. If you have questions, drop those questions in the discussion forum or email me. Thank you so very much. This is Kevin Zhao, your finance professor at MTSU.